What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, avabenesocky and augustbiniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. All right, everybody, welcome back to Real Estate Investing Demystified. I feel like it's been a while since we chatted on here.
Yeah, it's been a while. We feel a little rusty. We've traveled the world. We've been in Florida, Naples, Salt Lake City, all over the place. So
I'll tell you one thing. When COVID was here, Canada was actually shut down. It was kind of a good thing because we didn't have like this.
Yeah, you could be nerds, just sit at home and work. But now you're traveling.
But now that the borders are open and everything else, we have been traveling nonstop to the most amazing conferences ever.
There's another great one we're gonna be traveling to,
which we're gonna be mentioning here actually. And we're gonna be. I think we've been to how many conferences, August? We've lost track. We've lost track. I've had the pleasure of speaking on stage about investor psychology at Salt Lake City, the best ever conference. That was probably one of the best conferences.
Yes.
But we are gonna be actually meeting Omar Khan here in Vegas, April 26th to the 28th. And he's putting on a conference. It's a multifamily wealth project. So
come on down to Vegas. Let's have a great time. We party it up a bit, go to all the nightclubs and all the great stuff they have there, and go to the multifamily conference. What's better than that? It's like the best of all worlds.
Amazing.
Right?
And anybody listening, guys, we do have a 25% off discount code. So if you hear this, make sure you reach out to me and I'll go ahead and send that over to you because you got to come join us. It's going to be amazing.
Send us an email, send us a message. But currently we're in this choppy environment when it comes to interest rates. Interest rates have been risen, in a hyperbolic way by the Fed. It's causing some distress in the banking system. Some banks are failing. It's really scary times. Yesterday, the Fed had a meeting, and March 22nd, and they still increased the interest rates by 25 basis points. So even though the banking system is somewhat fragile right now, they believe it's not, and they're because they're basically pumping money into keeping the banking system alive.
Yes.
But how does this relate to multifamily real estate? It relates to it because in these choppy environments, it is the groups that are doing asset management the right way that can survive the storm. It is groups who also bought the right deals, but more importantly, asset managing the right deal. A lot of experts talk about, is it the horse or the jockey? And by far, most experts always talk about it's the jockey. A good GP can always salvage a bad deal, even if it was bought in the wrong time or what have you. So we have Omar. Omar is an asset manager on a lot of his deals. We're going to go over his background and experience. We're going to give you guys a crash course on asset management, which I feel is very important in this environment currently.
I couldn't agree more. So a little bit about Omar, guys. Omar is the founder and principal at Boardwalk Wealth, a Dallas-based private equity firm connecting international investments with U.S.-based international investors with U.S.-based multifamily real estate opportunities. Now, led by Omar, Boardwalk Wealth has managed over 200 plus million of multifamily real estate transactions. Now, he has advised on $4 billion in capital financing and M&A transactions in commercial real estate and commodities. He is the exclusive advisor for high net worth families and international entrepreneurs on their US-based real estate portfolio allocations. So we believe this interview with Omar will bring great value to both active and passive investors on the topic of asset management. So I'm excited to learn more. Welcome, Omar, to our show.
Thank you, guys. I really appreciate it. And I'm a returning champion, so always happy to talk to you guys and to see you in Vegas.
That's right.
Absolutely. Yeah. Go ahead.
Let's get started, Omar. Maybe you can just tell our viewers a little bit about your background and then your start in real estate, and then we can get into the asset management.
I mean, look, my background is a lot like people who work in investment banking, asset management, portfolio management. Graduated from University of Toronto in finance, did my CFA, worked at a couple of bulge bracket banks within Canada. I moved down to the US, I think late 2015, early 2016, somewhere in that region. My family's a business family, so they had their businesses, so I always had the entrepreneurial bug. And they're reasonably financially sophisticated, and being in the financial industry, that obviously helped. basically in understanding various tax structures, operations, all of that sort of stuff. So, when it came time to actually deciding, okay, well, what do we do with the rest of our lives post when I got married? We pretty quickly realized we wanted to be in a line of work that was very relationally driven. So it had to be, by definition, some sort of a private market. It had to be tax efficient because, my wife and I, we kind of just did the maths when we were 30. And we kind of quickly realized, look, even if we don't get a raise, and we were doing pretty well for ourselves, relatively speaking. I was in finance, she's a physician. So combined household income is nice. But we thought to ourselves, look, even if we don't get a raise ever again in the future, right? We're 30, we don't get a raise ever again. We're still paying a couple of $100,000 in taxes every year. So, if we can find a way to chip at that goal, right, then that's just free cash flow that you've unlocked, right? So you don't technically get a raise from work, but you've kind of gotten a raise in terms of cash, right? So combination of those things, but I think the biggest impetus was that my personal and professional background was a good fit for what I wanted to do, which was have the entrepreneurial bug. And then real estate was a pretty easy sell because, look, it's a private market, it's very tax efficient, and you don't kind of have to go explain it to people, right? I mean, instinctively, people kind of understand what's going on. So the sellability of that aspect of, hey, what do you do, right? That sellability isn't really that hard. So that's kind of how it started. But again, if I didn't have the background leading up to it, the technical and the personal background, then I could think about all of these things, but I just would never have the tools to effectively put together what I was putting together, right? So having the set of experiences really helped me. Otherwise, I'd just be another guy with a problem, right? So that was basically the impetus. And, once we got started, we have restaurants now. We're looking at a couple of factories to acquire. So once you get down on that journey, there's many ways that you can diversify yourself. But the point is to get started on that journey.
Great, great. And let's break this down a bit more. You're a high income earner. Your wife is a high income earner. You realize you're paying a lot in taxes. You realize real estate could be a vehicle to assist in reducing those taxes. You get into real estate. Now, a lot of people watching, this term real estate is too broad. This is a large ecosystem. There's a lot of different things you can do it. Aside from its initial investments you made, you got into real estate private equity. This concept of buying real estate with a group of investors or selected amount of investors where the equity needed for the project, majority of the equity needed project is coming from these passive investors, be it retail, institutional, anyways, individual, it could be your family and friends, but it's coming from another group. It's not coming from your own group, this concept of syndication or real estate private equity. When did that light turn on? Was it out of a need? Was it out of a want? Did you pursue it immediately? Talk to us about that transition because it's very important. I was in real estate over a decade before finding out there was even an option to raise money. This concept of raising equity, I didn't even understand it. So talk to us about when that light turned on for you.
Well, I wish I could tell you I know how to raise money effectively. I've got the unlock the secrets. I don't. But look, as I mentioned, a lot of this stuff was because of my personal family background. So my family's a business family. They're actively involved in capital markets as well as their own businesses. So I at least had the awareness that, a lot of these deals, private transactions that are done are not just with somebody, one guy writing a check all the time, right? Like there is some aspect of pooled funds. Now, whether you pool your fund because you've all got rich buddies or you're at the country club or whether it is done institutionally, but funds are pooled together. Like nobody's just putting all of their eggs in one basket. So that awareness was always there. And now I would love to tell you that awareness was there because I was some profound thinker. That's not the case. It was primarily just observing what my family was doing, what other people were doing in our social circle. So that awareness was there, but having awareness and then knowing how to do it are two separate things, right? So the awareness was always there, just by observing other people, but I didn't necessarily know how to do it.
Got it. Got it. Let's break it down even a bit more. You believe in real estate. You fundamentally understand that there's a way to raise capital. What was the first asset class you focused on? We know commercial real estate. There's multiple asset classes: multifamily, value add, development. What was the first thing you got your hands on?
I just did multifamily. I wasn't interested in houses. Hotels are too operationally intensive, so maybe that's a future thing when I built out the team. Retail, I was kind of iffy about because that's really, the rough math for me basically says that, again, I'm not an expert in leasing, right? So, and just TI, leasing, all of that stuff. So first of all, your cash flows are very lumpy. And secondly, it's very much a hit and miss sort of deal because essentially all you're really banking on is compressing cap rates in retail, right? So that aspect didn't really work out for me as well. So really, it was really industrial or multifamily. And Seems like some days it feels like I should have just gone to industrial because that's a way harder line. But essentially you have to pick a field, and multifamily just seemed like a more easier field to not only get into, but also to advertise what you are doing. Because the explanation of the business plan, I mean, I can explain this to my mom and she gets it, right? So whereas with industrial, a lot of times you might have to explain it. So I think it was the path of least resistance I took once I eliminated other opportunities like, say, hotels, hospitality, what did we say? Retail, office. Office was never on the cards because its revenue is too lumpy. There's just lots of different cash flow issues there that I just didn't want to get involved.
Got it. We talked about the business of real estate private equity. We talked about asset classes that exist. Now, within the multifamily value add asset class, there is a business model utilized. I'll break down this business really into three main points. You got the equity side that we discussed, raising capital from investors. You got sourcing the deal is acquisitions, finding the deal, underwriting. And then you got asset management, which is executing the business plan. You bought an asset, great. You raised the money needed, great. Now you got to execute the business plan, whatever that plan is. Even if the plan is just to sit on the asset, make sure you keep the occupancy high and sell it in 5 years, which is very simple. And a lot of REITs and large institutions do this. Talk to us about asset management. At what point did you start having the asset management on your own shoulders? Did you initially bring on an asset manager? And the reason I ask this is because you're connected and with one of the Goliaths of this space, Neil Bow Wow, and he's trusted your experience and background to bring you on as a partner. So you must have been doing something right. Tell us about your involvement. How do you get involved from coming from your background in finance, investment banking, all that stuff into actual asset management? And when we're talking about asset management, we'll ask some further questions differentiated between the financial advising world. But talk to us about at what point do you realize that you want to be hands-on with the asset management of your properties that you're buying?
Well, the other part I forgot to mention from the earlier question was that operationally speaking, multifamily is, in my opinion at least, much easier to operate because it has so many more levers where you can kind of, you can pull like 5, 6, 7, 8 levers to kind of drive value. Whereas with, say, other areas, I feel, again, I don't have experience, so this is just a high level overview, that you don't have that many levers. So for instance, if you're stuck in a long lease with retail or office, man, you're stuck in that lease, right? You're not getting out of that lease anytime soon as the market goes up, right? So first of all, computationally and operationally, I feel multifamily is a very vanilla type product, right? Vanilla in the sense that it's really cash coming in, cash going out. So if you understand your cash conversion cycle, accounting people would understand. And it's kind of simple, man. I mean, it's really not that hard. The real, for instance, art, I guess, comes in is in your temperament. Like, do you want to go buy the dirtiest, grimiest thing? Or do you want to go buy the shiniest object? And where do you lie on that spectrum, right? Because oftentimes that determines like what actions you can take. So for me, it was very simple. Because computationally and day-to-day multifamily management is relatively easier to do, asset management at least, right? So therefore, it wasn't really that hard. If anybody's coming from an investment banking background, you've done valuations, you've created pitch decks, or you work on the buy side, I mean, this is as vanilla of a product as you're probably going to get. I mean, I know people think it's hard, but let's put it this way. Multifamily is a lot easier, like acquisitions, value add multifamily. Again, unless you buy like deep distress in the ghetto, short of that, right? Because that's a different element altogether. It is as vanilla of a product as you're possibly going to buy in the private markets as, yeah, I don't even know what an accurate comparison is. So it is relatively so much more simpler to say, do this, than to say, think about it this way, right? You want to buy an oil and gas company, which has like, I don't know, 15,000 wells all across like 3 basins, right? So it's a very vanilla product. So from day one, having the financial expertise and having that background was really helpful, but it was also compounded by the fact that this was a relatively easier path to take. Like I told you, right? I took the easier path, right? So the easier path also implied operations. The easier path implies scalability. The easier path implies how do you deal and course correct along the way operationally.
Got it.
Right on. Now, Omar, could you differentiate between asset management and finance and real estate asset management?
I think it's kind of the same thing. It's just in a different product. So for instance, asset management essentially means that, you have a business plan and whatever it is, whether it's a multifamily, whether you have you're a financial advisor, you have to create a business plan for the future, for the next X amount of years. And in that business plan, you start from the end goal and you kind of work your way backwards. So as an example, if you're a financial advisor, you have a client, say a doctor that makes 300, 400, 500 grand a year, and they say, I have, say, $200,000 of whatever investments, and I'm going to retire in 30 years, and I want to have at least $5 million. Well, what's the paths to get there? What are tax breaks you're going to get? What vehicles you're going to invest in? Well, it's the exact same issue or the same plan within multifamily. Think about it. If you get, say, a Class B asset, like we've got tons of them, right? Or Class A asset or developments, right? You decide, okay, my cost of acquisition is X. Like, let's assume it's 100,000 a unit. I budget, because I've sent an RFP, I've got bids. It's going to cost me at least like $10,000 to $15,000 per unit to renovate whatever product I have, because I've researched it, right? How many units I'm going to renovate. And let's assume it's a 100-unit building. So you say it's going to cost me $10,000 to renovate per unit, again, assuming interiors and exteriors, right? We're just going to keep it simple, right? And we have 100 units here, so I think that's about $1 million, 10,000 times 100, yeah, that's $1 million, right? So now I say, okay, $100,000 purchase price, $10,000 capex. Maybe you add a little fudge factor on top. Maybe you add another, say, $5,000, $6,000, right? So you say, okay, my all-in basis when I'm done with this project is going to be, say, $115,000 to $120,000. Now, in 3 or 4 years' time, you have to make some assumptions, right? You can't assume like the world's going to end, right, all the time. With some assumptions, you're going to make, hey, can I get to this stage where if my basis is 120, can I sell it at the bare minimum for over 120? Well, that's the bare minimum, right? Or can I sell this for 150? And how would you assume if you could sell it for 150? Well, one is obviously you're going to do your underwriting, you see your numbers, and you kind of do that analysis. But you also look at comps, same as the single family market, right? If you see, for instance, that the guy down the street, similar type of product, bought their asset for X, but they were able to sell it for, say, $140,000. It's very similar. Let's assume it's a 90s vintage product in Buckhead in Atlanta. Everything's kind of the same, right? With some exceptions, right? Well, now you have something to compare yourself against, right? So what also can you compare? You can also compare that if your model assumes, or your assumption is, hey, my rents were, again, keeping things simple, my rents are at $1,000, and year 3, my rents are going to be $1,500 for it to be a viable enterprise for me, right? Then if you go out into the market and look at other similar properties that your renters might be able to rent, and say the nicest product out there is barely scratching $1,100, right? Well, now you've got a huge gap. And unless something drastic happens, it's not like rents are just going to jump up by like 40, 50% in 3 years, right? So a lot of this is, for instance, science, where you'll actually do the underwriting, but a lot of this is art and common sense. Like if the guy down the street has bought a Class A product at, say, $150,000 a unit, and you're buying a 70s vintage product at $140,000 a unit, that's not enough of a margin of safety, regardless of what you do.
Omar, just quickly here. So when you make the comparison of asset management in finance and in financial advising, but asset management of multifamily, I would say the asset management on a multifamily level, it's more hands-on. You're also in a way involved, you're more hands-on. When you're talking about asset management in finance, in financial advising, you're just structuring, forecasting, and strategizing. Whereas asset management in multifamily, you got to hire a property management team if you're using third party. If they're not performing, you got to go in there and fire them and bring in a new team. So it's much more hands-on. If you have a contracting team, certain material comes in, you're very much hands-on and getting your hands dirty and playing more of a management role than when it comes to asset management and when it comes to managing portfolios and what have you.
Look, I would agree with that if somebody doesn't have their systems together and they don't have their discipline to buy, say, within, say, a sandbox, right? So, for instance, if your sandbox is 80s and 90s value-add deals in the Southeast, right? Whatever, say 100, 150 units, pitched roofs, average demographics are, say, $60,000 to $80,000, you kind of got a little bit of a model, right? Then it is not as onerous as, for instance, if one day you're buying, say, in the ghetto, the next day you're buying Class A, the third day you're doing development, the fourth day you're in a completely different market with completely different dynamics, right? So again, I'm only speaking from our experiences, right? We kind of have a little bit of a sandbox, right? It doesn't mean that other good deals aren't outside of that sandbox. There's many good deals out of that sandbox, and many people have made a lot of money, more than us, in fact, right? But we want to play within a sandbox. So all of our, say, processes, all of our systems, all of our contacts, all of the ways we set up our company are aligned with these systems and processes. So therefore, the hands-on aspect, while it's important, we have enough data, we have enough reporting structures, and we have enough of a history to kind of see a lot of things before they happen. Now, you don't see 100% of those things, obviously, right? So therefore, for us, while at the start it might have been very hands-on and day-to-day, now with all of these structures in place, again, because we're only playing in a sandbox, it is not as onerous as you would imagine it to be.
Got it.
So, but again, it just depends on the business model you have. If your business model is spray and pray, then it's a different ballgame, right? And think about somebody who's in hospitality, office, retail, industrial, short-term rentals, self-storage. I mean, all over the place, right? Their asset manager, I don't know, would just have to be out of this world amazing. Versus say us, where we're just subject matter experts, but in a very narrow range, basically.
Got it.
Right on. Omar, I'm kind of curious. Does an asset manager get involved in the acquisition process, and how important is this?
Yes and no. For us, yes, they do, because our company is very close-knit. But say if you're looking at bigger companies, oftentimes they don't, and that's actually a big problem in bigger companies, because the acquisitions guys are paid to do deals, as an example. So think about it this way: if somebody's incentivized to do more deals, they are just incentivized to stretch, which might not be an accurate reflection of reality. So in a lot of bigger institutional firms, there is always that tension between acquisitions, which is considered front of the house, and asset management, which is considered back of the house. In companies of our size, that are medium-sized companies, our team is closely knit, right? And we only do a few deals a year because the bulk of it's our own money. So therefore, our teams are very closely knit. But again, I'm not trying to say that model is wrong, because once you get above a certain threshold, right, you're at the 10, 20, $40 billion mark, you have to put these boundaries in place. So you can't win. It's just a matter of size, basically, right?
Got it. Omar, you're also involved in ground-up development project aside from multifamily value add. Now, again, there's the titles and wordings and using the right phrases. Is asset management in a development situation, does that exist, or does that only come into play after the asset has been stabilized and then the asset manager comes in? Or is that responsibility from day one kind of idea?
Yeah, it's responsibility from day one, because part of the asset management is also making sure that our development partners are on track as well, right? I mean, for instance, if there's a delay in closing, why is there a delay in closing? If we're going above budget in certain things, why are we going above budget? Then you also, look, at the end of the day, you can use whatever term you want, but the fact of the matter is that you have to always be communicating with various aspects of your team members and various roles. So the purpose of, say, the asset manager in that regard is kind of like a hub and spoke model. The asset manager is a hub, and all of these other things are spokes. So just because your product hasn't delivered doesn't necessarily mean there's no work. So I'll give you an example. We're delivering a product late July, early August, Blue on Lorraine, right? But we already have to start doing the pre-leasing for that, right? And in the pre-leasing of that, before we actually even have to do the pre-leasing, every year before the pre-leasing even starts, every month we have to be in touch with our property managers. So we're going to start doing the property management once we start pre-leasing, to basically accurately get an idea of, okay, where are rents, where is our budget, and we have a rolling forecast made, right? So every month we're tracking, basically assuming this property was already running, right? Hey, how are we doing? How are we doing? Because by the time this property starts pre-leasing and then it actually starts leasing, we don't want to be caught with a surprise. So if the market, for instance, is going up, then we're already adjusting our expectations. Or if the market is going down, then we're already saying, okay, maybe you offer more concessions during pre-leasing, right? Instead of offering, say, 0 months of concessions, maybe you start with 2 months of concession, and maybe we've got to do more advertising locally. So those aspects, they always stay, whether you are developing, whether you're acquiring, whatever it is, those aspects always stay.
Fair enough. Quick question here. If there was no private equity involved, if there was no capital raising involved, what would that title be called? Because when I was in construction and real estate and what have you, we never had the term asset manager. We had development manager. We didn't really have asset manager. Is that term just used when there's private capital involved, or is it just...
I'm going to be honest with you, I don't know the answer to that, right? Number one.
Fair enough.
Look, I think it's just like a title. You can call it a project manager, right?
Fair enough.
Right.
Fair enough.
I just think it's a title, right? It's just a commonly used title, so people don't even think about it. It's like how every second person in a bank is an executive director.
Got it.
Right?
Perfect.
Yeah.
Fair enough. Fair enough.
It's just a title. It doesn't really mean anything.
Let's switch the conversation a bit here. Let's talk about the elephant in the room. Before our recording, we were talking about the conference, and I'm going to be speaking on the panel about this topic, which is distressed assets. We know there are distressed assets coming to the market. We know I was interviewing John Chang with Market at Millichap, and he also believes there's distressed assets coming to the market. Now, the economy and the banking system is not sick the way it was in 2008. They're not over leveraged and what have you. You don't have people defaulting, and you don't have, in a lot of movies you see that was made about the GFC. You don't have people that have no business owning properties, owning 5 or 6 different properties. You don't have those defaults coming in where it's going to be the deck of cards, but you have distressed assets coming in because a lot of groups that syndicated deals, a lot of groups that went into deals either didn't buy rate caps. If they bought rate caps, they didn't have enough reserves to repurchase their rate cap and how high it went. Nobody really expected the rates to go up this fast. So we know that there's distressed assets coming to the market. Now, on the flip side of this, again, in my discussion with John Chang, he talks about he has clients who have billions of dry powder ready to be deployed into this asset class. So we're smaller syndication groups. You're a boutique private equity firm. How do we compete with billions of dollars of institutional money, which they're buying the same asset classes that we're buying, when there is a turn in the market? Because there's another very important point I want to talk about is there's a lot of firms out there, unlike our firms, who have 50, 60, 100 employees, and they haven't done a deal since July. They got to feed those people. And the way to feed those people is through their acquisition fees and asset management fees. And, maybe they can exit some deals right now. But we're competing with groups who need to do deals. So how do we compete? How's that going to work? Let's touch on that a bit, and then we get into the importance of asset management for groups that are surviving this choppy time.
Guys, it's the same answer as how we were competing when the market was good. The same answer is how you compete when the market is bad. If the deal doesn't work, you don't do it. Look, for instance, if somebody has a bigger payroll, as an example, right, and they have to do a deal to feed that payroll, well, that's a them problem, right? That's not a me problem, right? I mean, it's a bit like, if I do, as an example, if I do something stupid, that's not their problem, right? That's my problem. I have to go deal with it. So, and the other part also is, look, if somebody has billions of dollars in dry powder to deploy, they're probably, I'm not competition for them, man. They're not looking at the deals that I'm looking at, number one. Or, for instance, God help them if they were competing with me, because that's all I'll say, right? That would suck for them more than it would suck for me. But look, my point is that at the end of the day, it is what it is, right? I mean, if somebody is willing to pay more money, that's just the private markets at work. I mean, yeah, it sucks and it's awful, but what are you going to do? But the flip side of this is, look, man, this is a big country. So there are always deals out there. And yes, sometimes it's bad and sometimes it's good, but nobody was complaining when times were really good. None of us complained. I didn't complain, right? So if you don't complain when times are good and say, you know what, maybe I shouldn't be making all this money, right? Maybe I just get up and making money. This is not normal, right? Then you can't really complain on the flip side. But this is a cyclical industry, guys. The market giveth, the market taketh. And as long as we hopefully chart some middle ground and we don't get that affected, hopefully, right, we'll be fine. And if somebody has a big payroll and they want to do more deals, well, if they keep doing stupid deals, they're not going to have a big payroll for too long because they'll be bankrupt.
That's right.
So it is what it is. I mean, it sucks if you're on the receiving end of it. Look, I'm on the receiving end of it sometimes.
Yeah.
But it is what it is. I mean, nobody's going to change what they do. So what do you do, right?
That was a great answer, Omar.
It sucks, man. But yeah, if somebody with $1 billion is competing with me, man, God help them, man. I feel sorry for them, man. That's all I'm going to say.
Right on.
I'm small potatoes compared to that person who has $1 billion in equity.
Absolutely. Omar, can you provide examples of successful asset management strategies that you've implemented in the past?
Yeah, look, I mean, for instance, I can give you current examples right now. We always have a rolling cash flow forecast. But we even have, now we're even doing intra-month cash flow forecast. So if I'm on, say, the 10th of the month, I have to look at my cash, just operational cash position, right? Not excess cash or whatever you have, right? We're even doing that within the month. I mean, we always wanted to do it, but when so many things are happening, you have to pick and choose your battles. Additionally, for instance, liquidity management, for instance, we always did this because I've seen it within my family. The only reason why, for instance, I'm the third generation, we've been able to survive through 3 generations in multiple countries isn't necessarily because my family is smart, because I know my family, they're really not that smart. It's just because, we were always somewhat prudent in the allocation of our cash. And most of my family members didn't chase the shiny object. So, in good times, it feels like everybody's getting ahead and you have FOMO, massive FOMO, right? Well, how's this guy getting ahead of me? And how's this guy making more money? And I have that too, right? But in bad times, you realize, oh, at least I'm not losing money, right? And I'm not bleeding left, right, and center. So for us, a lot of it's things that are going to stay the same. Your bi-weekly meetings, say on the corporate side as well as the property management side, daily touch bases with the property managers, me and my managers, for instance, and my operations people, we each have each other's phone numbers. So a lot of time, if I have to pick up the phone and call them in the evening because, we want to change this or we want to do that, a lot of times that lines of communication are open because people say, hey, what are you changing? The problem is if you start changing anything now, it's already too late because water's already gone over the bridge. These are things you have to do before bad things happen. You have to be doing these things during good times. So you train your team because oftentimes it's a training issue as well, right? Well, does your team even understand what you want to do? And then have you put the right reporting structure and all of this in place? So if you do this now, you're already behind the curve. You're already going to lose it, basically.
Got it. Now, again, touching on distressed assets and what have you, one of the reasons a lot of distressed assets are coming into the market, a lot of people are in difficult times, a lot of sponsors are stopping or reducing cash flows. A substantial reason for that is the capital markets and the interest rates, but a portion of that is also, their inadequate asset management. Over the last 12 years, I would say not just the last year, but the 12 years prior to that, anybody could make money. Rising tides raise all ships. So people were buying asset classes, buying assets. They weren't even doing anything. They weren't even doing a value add, and they're just selling it in 3 years and doubling their money. So, when the tides go out, you can see who is standing there without their shorts on, right? So how important is asset management when it comes to executing the business plan? Again, we've touched on it multiple times, but can you give us some important pointers? Is it to maintain and increase occupancy? Is it to maintain and increase rents? Is it to execute the business plan in the right way, knowing how many units you have to renovate? Talk to us about kind of some pointers there.
Guys, it's all of that. For instance, it is to renovate, for instance, units on time, but it is also to realize that if you're renovating these units, as an example, are you getting the rent bump or not? So, for instance, in a particular few cases, and obviously I'm not the only one, for a few of our assets, what we were realizing is even if we didn't put any money, people were still renting those units out from us. So we didn't put any money in some of the units because why would we put more money if we could get the same rent? So, but if we just blindly went and just renovated the units, right? Because we just wanted to renovate the units, right? That would be not the most judicious use of our money. Similarly, for instance, right now, we're really focused on upping our occupancy. I mean, our portfolio is typically always mid to high 90s, but we want to push this into the high 90s across the board. Because the reason is, I personally feel it's more of the fear of what is coming ahead as opposed to what's happened in the past or what's happening right now. So it's all of these things. But at the end of the day, if you don't buy with discipline, as an example, or let's put it this way, your deal has to be salvageable, right? If you bought a turd, shining it is not going to help you, right? So a lot of this starts right at the start. If you buy something that is salvageable, there is something to do there. You have a clear path, right? It's in a good sub-market. You have some comps to support what you do. Well, then you can actually do something, because otherwise what I see is a lot of times what happens is people fire their property managers, right? And you're like, sure, maybe the property manager isn't performing, but you also chose to buy a ghetto deal in a tertiary market where there's like 2,000 people, right? So what is a property manager even going to do, right? I mean, there are limits to what a property manager can do, good or bad. I mean, look, when somebody's doing bad, you obviously know they're doing bad, right? But even a good property manager is not a magician. They can't walk on water. So a lot of these things start right at the start, right? That did you buy with discipline in the right markets?
Got it.
If you did that, then yeah, you can pull all of these levers and do your little Wizard of Oz thing, right? But if you don't buy right, then none of this other stuff matters, basically.
Got it. We got a couple of more questions before we get to the next segment of our show. I got one question for you. As an LP, right? LPs the reason they're LPs is because they have focus on their main business. They're doctors, they're lawyers, they're accountants, they're high income earners, business owners. They want to diversify and they invest with syndication groups like us. When they're vetting us, how important is asset management? Should they request to get on a call with the asset manager? Should they see the business plan? Like, how do they vet this concept of asset management, which is crucially important? How do they do that as an LP?
Well, number one, I'm going to be very honest with you. Unless you're in the industry, there's no way for you to vet it with any level or degree of confidence, right? So get this idea out of your head, right? Look, it's the same way as, for instance, God forbid, if I go to a cardiologist, right? There's no way for me to accurately know like how good or bad a cardiologist post till something bad happens, right? So there is certain level of, for instance, base level of due diligence. So you see, for instance, who do they have on their payroll? I mean, you should see it on their website, right? I mean, it should mention something, right?
So should they have an independent asset manager?
Like independent of what?
Like a department, like an executive who's
focused. Yeah, definitely. Yeah. Like within the company, you're saying, like somebody on the payroll?
Yes.
Oh, yeah, definitely, dude. They should definitely have somebody. Look, my point at the end of the day is, if you're giving your money to somebody who doesn't even reinvest back into their own business by either hiring people, by buying software, or whatever steps are needed to improve the quality of that business or the quality of the service that the business provides, then why would you give that person money? Right? Look, it sucks. I mean, I've got a payroll. I don't look forward to paying everyone's salary, but I also realize that it is better for me to provide good value, and it helps us become better and better because it's a constant work in progress, right? You're never like 100%, as opposed to doing everything by myself. It's not like I can't do asset management, but invariably there's only 24 hours in the day. So I have to hire the right people. So if somebody can't even spend money on their own company and reinvest back into their own company, yeah, number one, that is a big red flag. Number two, what I tell people is, look, there is no five-step guide to success. Okay. But look, I invest in other people's deals in real estate and outside as an LP, right? Even like in the markets where I'm invested in, because if I like somebody and I know they're good, I'll invest with them, right? Right. So what are the two things that I'm assessing typically people for? I'm assessing people for competence and character. And the idea is, look, if somebody is great character, they're really honest, they're awesome, but they're a complete idiot. I mean, that's not really a good, you don't really want to give your money to that person, right? Conversely, somebody's world-class at what they do, but they're a Bernie Madoff type person, right? They're a complete crook, they're a ripoff. Well, you also don't want to give it to that person, right? But this assessment of competence and character, this is qualitative. This is not like you don't have like an Excel model where you just check, and you're done. And by the way, this is the problem that many big allocators have. Companies like Blackstone, companies like CalPERS, CalSTRS, Texas Insurance Retirement Plan. These people have the same problem when they are assessing companies like Blackstone, Apollos, KKRs, all of these firms. Like, how do we know that you're adding value? So this isn't like something that, say, a doctor has, but people higher up don't have. This is a perennial problem, basically.
Got it. All right.
Okay.
You already know we're making big moves. We're going to switch the conversation a bit here, but we're making big moves. We've always talked about, our plans to move to the U.S. And one of the reasons,
we've been manifesting that for the last 3 years now.
Yeah, no, absolutely. I mean, our business is investing in the U.S., so it just makes sense to be living in the U.S. I've always felt more American than I did being a Canadian, but we're making that big move as big news are coming down the pipe. But we want to talk about about yourself. You talked about University of Toronto's, but go ahead.
Yeah, we actually touched on this a little bit on the last time you were on our show, and I really love this topic. But you were once Canadian. So first of all, what made you're still Canadian?
You once lived here physically. Yeah.
You once lived here.
A resident, Canadian resident.
Yeah, I once lived there. Yes. I'm still a Canadian citizen. I go back on and off. I love Canada.
Perfect. Okay, so let's tell everybody what made you kind of pack up shop and move to Texas, and then what are the main differences that you find between doing business in Canada and the U.S.?
Oh, I didn't move to the U.S. for business. What happened is when I met my wife, we were engaged. She was doing a residency in upstate New York. I was in Calgary at the time. So, we eventually had to decide, hey, when we get married, we eventually have to live together. Where do we live? So it was a toss-up between her moving up to Canada, so we could go Calgary, Toronto, Vancouver, wherever, or me moving down to the U.S. So I kind of decided, what's the worst that could happen? I'll move down to the U.S., right? That's not bad. But again, we decided, okay, we're not moving anywhere cold. We're not moving to the Canada of the U.S., right? So it has to be somewhere warm. So really somewhere warm was Southern California, Phoenix, Texas, Florida. Florida, I mean, it's nice, but it's too hot. I mean, it's a bit too much, right? Phoenix, it's kind of nice, but it's kind of in the middle of nowhere. It's a nice city. I mean, I love going there, but I wouldn't like want to stay there. Southern California is awesome, but I'd have to be a billionaire to live there, right? So really, the toss-up was Texas. And Texas, it's all the stuff, it's fast growing, big business, big economy. Texas economy, I think, is bigger than Canada's economy.
Yes, it is.
Right?
It is.
So I interviewed for a couple of jobs in Houston. I interviewed for a couple of jobs in Dallas. I know it's going to piss off a lot of Houston people, but I thought Houston was a ghetto. It's a dump. So when I came to Dallas, I was like, wow, love the city. It's pretty cool. Nobody signed me. So I wish I could tell you that I had a grand plan about business and this and that. It wasn't. It was just, we were engaged. We decided to move. Now, what is the difference in business? Look, way more opportunities here. People want to engage with you. People want to do business with you. So in that respect, it's a night and day difference, basically. I can't even give you a comparison because it's such a stark comparison. When you see it, you know it when you see it, basically.
Of course. What do you feel about the investor mindset of Canadian?
American mindset is more equity oriented, right? Whereas Canadian mindset is more, American mindset I've generally seen is more growth oriented, which by the way it can be good or bad, because growth oriented also means growth at all costs can also be kind of bad. So, but generally, my point is, if you want to do business, it's much easier to do business in the US than Canada. Way easier. It's not even a comparison.
Awesome. All right, let's get to the next segment of our show.
Here we go. 10 championship rounds to financial freedom. Are you ready, Omar? We're going to ask you 10 questions, whatever comes top of mind. Let's do this. Okay, number one question. Who was the most influential person in your life?
Oh, I would definitely say my parents. I think that might be a cliched answer, but definitely my parents.
Okay.
Nice.
Okay, beautiful. Number two, what is the number one book you'd recommend?
Doesn't have to be a real estate or finance book, any book.
Yeah, that's a tough one, guys. I read a lot of books, and so yeah, I can't really pick one book. So I'm a voracious reader.
But is there one book that has come to your mind in business and life that you go back to when you think about? Is there a particular book?
No, because I just keep reading books and I read articles. So, but there's lots of books. My point is, what I'm trying to say is there's so many books that one doesn't stand out. That's what I want to say.
Fair enough.
Nice.
I'm a voracious reader. I love reading. So that's why I'm sorry. I wish I had a better answer.
No problem at
That's
all.
perfect. Okay. Next question. If you had the opportunity to travel back in time, what advice would you give your younger self?
Oh, just put all my money in rate caps 2 years ago and make 30-50x return in 1 year, buddy. Boom. Done.
Explain that. What do you mean putting your money in rate caps? Rate caps is an option to invest in rate caps?
Yeah, of course. You can invest in any derivative product you like. It's just a derivative product, man. You can do anything you want.
How do you go about doing it? Like logistically, who do you call?
I mean, can you trade derivatives on your whatever brokerage account? Just go there.
You just go literally just buy it by clicking
It's an interest. Look, rate cap is just a fancy way of saying that you're betting on the movement of interest rates, essentially, on a notional amount. So you can just buy it. I wish I knew the future, and I wish I had the balls to do it. And I wouldn't even go too far back in time, just maybe 2 years.
Right.
Just take every single penny, max out all my credit cards, do everything, sell everything, put it all in interest rate derivatives, and just, I don't know, make 50, 100x returns in 2 years and just gotta buy my own island.
Yeah, wow. And retire.
I don't even go too far back.
I gotta learn more about.
We gotta learn more about that.
Rate cap investing, because I want to understand that a bit more.
I wouldn't necessarily recommend it as a means of making money, but I now know. You're telling me to go back in the past, right? So I know what's happening now.
Got it. On the next cycle, we can do it together on the next cycle.
I don't know about the next cycle, man. I don't think I'm that ballsy. But you said you had a time machine, so I'm going back in time.
All right.
There you go. All right, I like that. Okay, now next question. What's the best investment you've ever made?
Oh, definitely my marriage and my kids. Because marriage is an investment, right? So sometimes it's hard. I don't know if you guys are married or not.
We are. Actually.
Okay, yeah. So there you go. I mean, I'm sure it's not easy every day, right? But definitely the best investment of my life. Hands down.
Now, what's the worst investment you've ever made, and what lessons did you learn from it?
Oh, I bought Seadrill, which was an oil and gas driller. Offshore driller, because their dividend was like 7 or 8% in like 2013, and I thought I was such a hard shot, and it was a completely over leveraged piece of shit company, and I lost I don't know, I didn't lose a lot of money, but wow, that was like the worst fucking investment I've ever done.
Okay.
Worst, hands down. Seadrill. Do not buy Seadrill. That guy's a scoundrel, basically.
You live and you learn. Next question, Omar. How much would you need in the bank to retire today? What's your number?
That's a good one. I don't know what that number is, because number one, I feel like I don't think there is a number, because I might have the fear of like running out, right? number one. And number two, I actually quite enjoy, for instance, what I do. Obviously, I enjoy the money, but I also enjoy the fact that I get to meet very interesting people. Look, we're talking right now. It wouldn't have been possible if I wasn't doing this. I'm having dinner with a guy out of California today, and I just get to meet such an interesting group of people that are doing such cool things otherwise in their life, in different businesses and professionally, that I wouldn't have been able to do it if I was just working my job and doing all that kind of stuff. So the number part, though, I've always thought about it because you need to know when to quit, right? You don't want to be one of those guys who's like 80s and still kind of just chasing the dollar. But yeah, I don't know, maybe $100 million. I don't know. In cash,
100 million?
in real estate, not in just assets, cash, straight cash.
Straight cash.
Liquid.
Straight liquid cash, 100 million. And yeah, I'll probably think about it.
All right. Sounds
I'm
good.
very far away from that, but
All right. Okay, cool. Next question. If you could have dinner with someone dead or alive, who would it be?
oh yeah, I don't know the answer to that. That's a good one. Maybe who would it be? I don't know. Maybe my grandfather. He died like 15 years before I was born. So possibly my grandfather. I know that's not a cool answer, right? Or maybe I'd probably dead or alive. Oh, I definitely want to have dinner with Leonard Cohen. He's a great singer, right? Definitely would love to have dinner with him. But I'd probably pick my grandfather or Leonard Cohen in no particular order.
Grandparents are actually a common answer in our show.
Yeah.
Is it? Okay, yeah. So yeah, that makes a lot of sense to me.
Okay, Omar. Now you read a lot of books, so I'm excited to hear your response to this question. Book smarts or street smarts?
Street smart.
Street smarts all the way.
Oh yeah. But I mean, yeah, street smart, hands down. But again, if you're doing the type of work that we're doing, you need to have some level of book smarts because you can't just be uneducated. But again, there's diminishing returns above a certain level of book smart. To making money, not in living life, but to making money, there is a diminishing returns above a certain level of book academic knowledge.
Okay, last question. If you had $1 million in cash and you had to make one investment today, what would it be?
S&P 500 index, go to sleep.
Oh my God, you broke our heart, man. You broke our heart. This.
I think he said this last time.
Yeah, you broke our
If I
heart.
just have $1 million, I'm not putting it in real estate. Are you freaking kidding me? Man, fuck that. I'm not putting it in like an illiquid asset and it's just having, if I just have $1 million, yeah. If I'm on my last $1 million, yeah, I'm not putting it in anything illiquid. And anybody who does that, I think they got to get their head examined.
All right, man. Fair enough. All right.
All right, Omar.
Let's do this. What's the best way people can reach you, Omar? And then also talk about the conference as well. Quickly, how people can get it. We'll put it in the show notes, but just briefly touch on that.
Yeah.
Well, look, you can join my mailing list by visiting my website, boardwalkwealth.com. The form is right on the homepage. So again, that's at boardwalkwealth.com. And with regards to the conference, very excited that you guys have graciously decided to come and speak. It's April 26th to the 28th in Vegas, multifamily wealth project. Please use Ava and August's discount code because that's going to get you a lot of goodies, right? So look, the point there for the conference basically is to connect people who are actually doing deals, because a lot of conferences I've gone to are people who talk about doing deals, but then there's no follow-up, right? So basically the big conferences are good for you to network when you're starting out, but after that, you kind of have to go to these conferences, which are, say, 200, 300, 400 people level conferences like the ones we have, because all of the people coming there are either operators or they're equity raisers. And really, if you kind of want to take your game to the next level, that's kind of what you need. You need people who are actually doing the business, not talking about doing the business.
Awesome. All right, man. Really appreciate it. Thanks for taking the time. And it was exciting chatting with you again.
Thanks, Omar.
Sorry for breaking your heart, guys. I'm sorry about that.
You just broke mine, but that's
Good, Omar.
No worries. Thank you, guys. I really appreciate it. Bye for now.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.